Good morning, everybody. Welcome to the Flow Show. It's Tuesday, the 17th of January. As I say, the days have been flying by so far in the new year. Morning, Kay. How you doing, mate?
Hey, morning, Ryan. Good morning, everybody.
Everyone all good? Hope so. Right, a bit to talk about today. Quite a bit of data out, particularly from China. So let's take a butcher's at that first. See if I'm on the right page first. So the big numbers coming out: GDP, retail sales, unemployment, industrial production, quite a bit, and all pretty much surprising to the upside. GDP coming in flat, probably the biggest number, versus minus 0.8 expected. Obviously, with everything that's been going on over there, a lot of the market looking to whether the Chinese economy suffered really badly. Coming in flat in Q4 suggests not as bad. There are a few people who are looking at all this data and saying that perhaps, how should I say, it's being massaged in the way that China has in the past done so. Because we might have expected some of these numbers to be really much worse, particularly something like retail sales coming in only down 1.8% versus minus 8.6 expected. Unemployment as well dropping. So painting a good picture into the end of the year, into the end of 2022 for China. Whether these numbers are going to get hit in the first part of the new year remains to be seen. But overall, not looking bad at all. Staying in China, there has been some news on the other side. They are apparently going to extend some individual income tax breaks until the end of 2023. And the China securities press or securities news said that they may cut interest rates and the reserve requirement ratio sometime in Q1. So even though the data isn't looking as bad as many would think, China is potentially still looking to ease, likely to get them over this COVID wave that's happening. The NDRC also lowered retail fuel prices, and that's happening from Wednesday. So still easy measures, I say, coming into the economy from China. That news on the potential interest rate cuts and the RRR cut seems to have done for the dip in dollar yuan for now. We've seen a pretty hefty bounce up from those lows. The PBOC have been keeping their fixes the last couple of days above the 6.70 handle, indeed the 6.71 handle. So again, that may be a bit of an indication that they've let this pair drop as far as it's going to go. How far the bounce goes to remains to be seen. We're up to an old level at that 6.7879 area. That's where it's running into trouble for now. What I'm looking for this one is if we get another move back down to those lows and we find it holding, that potentially is going to be, at least on a technical front, a signal to maybe start getting long a bit of this. As you can see from that chart there, it is a bit of a sticky area down here. So no surprise that we've found a bit of glue there as well. What do you make of this one, Kay? Potential bottom of sorts in play?
It certainly looks like it, yeah. And I was already showing the other day there's a bit of traffic all the way down to 660. That could be the
one spot four.
Hold on, I'm killing my squawk. Yeah, that could be a decent level to look at, especially if they start to look at re-injecting liquidity and looking at cutting rates and stuff. That could be a catalyzer, catalyzer to go back perhaps closer to 7 at one stage. For the time being, I'm actually a little surprised we didn't get much more of a move. Not on the top side, but like that it's holding pretty well. Let's put it that way. That it's holding. Yeah. It's just went back up to, and we are hanging around here. It does seem the market is after the fact, not really buying it. And also there was this article saying that the for the first time in many years that Chinese population is coming down, so the people are worried about manufacturing and stuff, labor force. So it's all looking as it may reverse a little bit, but we'll have to see if we can get back above this 680, 80 and a half.
Yeah, exactly. I think I'm going to pencil this in the dead cat bounce camp for now, unless we see further upside. If we do get a break above this 679 area and we find it holding a support, then that will solidify the lows for me anyway. But as we mentioned, the fixes could be a bit of an important factor now that they were kept above that 670, 71 area, even while we were dropping down. So always keeping an eye on that one. Over to the Bank of Japan, and Reuters sources piece said that the new governor nominee is likely to be presented to the Diet February the 10th. That was soon knocked back by Finance Minister Suzuki. Says he's not aware of any plan to nominate the new governor candidate on February the 10th. He also said the rise in bond yields could push up the costs of interest payments. A bit of a no shit Sherlock comment there, but maybe an underhand warning about if yields creep too high. Obviously, with everything going on with the Bank of Japan, one of the possible moves that could happen is that they widen yield curve control or something like that. Again, that will push up the value of yields and impact on the government and their interest payments and future borrowings. So a bit of a warning there from Suzuki. Just coming back to the data as well. Let's have a look. There was a bit out yesterday. I thought it was out yesterday. Yeah, just some consumer confidence data from Australia and business confidence from New Zealand. Not looking too hot there in New Zealand. Business confidence minus 70% there. The consumer confidence up a bit in Australia. These are quite minor numbers, but it's always worth just keeping an eye on to see the general sentiment. So creeping up there in Australia. Further to today, bit more data out. We had jobs numbers from the UK, and again, not showing too badly overall. Unemployment rate holding steady. There, the claimant counts roundabout expected, but no real big numbers there. Wages ticking up there. Obviously, everyone with a glass half empty view still pointing out that wages minus inflation are in the negative, but they're still going higher. If inflation does pull back, it won't take much for wages to then be above inflation. But for now, wages, the trajectory is still upward. So things are catching up. Still got a lot of strikes going on. Teachers are said to be the next sector looking at taking strike action over pay. So we're still in the midst of all that sort of stuff. So there's still potentially a lot of wage inflation to come in the pipe there, as and when any of those get settled, with wages obviously jumping to higher levels. So that's something that's potentially waiting in the wings to come through into these sort of numbers. But overall, not as bad as some might expect the UK to be. Always a dour view on the UK from a lot of the UK press, but that's not playing out in the numbers thus far. I do want to mention something quickly, just on UK retails. And this is a sort of the ground level observation a lot of you can do when looking at the fundamentals. I was out in my local town Friday. I was out in another town on Saturday with a family. Absolutely packed. Friday night, bars, pubs, restaurants, full to the brim, up and down the street. Same thing on Saturday in a town called Winchester, close to me. Shopping centres, absolutely ramo. Restaurants, pubs, bars, again, absolutely steaming, which is a bit unusual for the time of year, because usually January everyone's half skint, had enough of Christmas and the New Year, and they're taking it easy. But it seems not. And I tend to notice things like that when things are particularly busy or particularly quiet at certain times when I'm out and about. So obviously one little situation might not be reflective of the whole country, but it could indicate that at least next month we get a half decent print from retail sales, and maybe the economy in January not falling off a cliff and tipping into a fiery abyss, as some people might expect. But again, I tend to notice these sort of things when they stick out a bit like that. So that's just a bit of thoughts. We'll see whether I'm right or wrong when we get the January retail sales next month. Over to the Eurozone, Germany confirming the CPI numbers there. Same with Italy, no change to the final numbers there. But the ZOO, big turnaround in the ZOO, went from minus 23.3 to plus 16.9. It was expected to improve, but only to minus 15, less crappy than before, but it's turned positive. Not that you'd know it too much in the price of the euro after those numbers. Some of the other numbers or the underlying numbers there, current conditions still looking crappy, worse than expected, though a slight improvement. But overall, the headline number is the one that surprised, and a bit of a surprise, Kay. Bit of a skew, or are things really on the look up in Germany?
Well, the thing is, it's all thanks to well, I mean, which is logic, lower energy prices, China reopening apparently, and then the inflation showing signs of coming back. But I thought it was a pretty big jump anyway. I was even a bit surprised. Looking at the expectations, I said, like, did they make a mistake, and should it be minus 16.9, which is still an improvement from the prior? But no, they kept the numbers at positive. So yeah, in a way, I reckon the market was kind of expecting it, although I do find it a pretty big jump in the sentiment. We've also seen that, as you say, on the Aussie sentiment overnight, where I'm a little surprised actually that Aussie Kiwi went down that much, since the New Zealand consumer didn't show the same optimism. The business confidence, sorry, didn't show the same optimism. Yeah, I'm surprised, yes and no. It looks like this ZOO is getting more and more volatile as well. So yeah, but still to be kept in mind, together with the rest of the European data, which are not as crappy as they were last year. So I bear it in mind. Bear it in mind. But the subdued reaction is probably also to do with the expectations or the advent of the Bank of Japan next night, where the market is really focusing on that right now. Also, as we've seen on the UK data, better than expected unemployment data, but then market already is saying like, oh yeah, but it's the wages are November data, and it's already back looking, and shrugging it off. You know, the market, the cable rallied a little bit, and now we're stalling around this 122, the figure. This seems to be the equilibrium zone of what's of the latest moves in the cable. The one cross to continue to keep an eye on, and I'm seeing Charlie's question. We're going to look at the euro sterling. Is the inability to move above 89, right, on euro sterling. So whether it be due to numbers, whether it be just market moves, we're going to have to keep an eye on that. I'm actually square right now. I'm flat on euro sterling. I'm really going to wait to see if we can break above. Then I will likely re-enter for a move up to 90 or so, but which I still think may happen. But in the meantime, it is possible that since the market always likes to trade short sterling, that some people may need to cover a bit more, and euro sterling, just due to a bit of flows, come back to the lower part of 88. That's possible as well. So we need to respect that level upstairs.
Yeah. Cool. Yeah, and just on that, Zoo, it's funny because that current conditions number doesn't smack like things are improving right now, because obviously the current conditions is what's happening now. And if that's down to if the overall sentiment is up on what's happening in China and it's not filtering through to how people view the situation now. But we shall see. It's a bit of a disparity in my view between those two numbers. So let's see what happens next month if that ratio closes up a bit. Just looking ahead quickly to the data we've got coming up before I tick into the other headlines. Canada CPI later, Empire State from the US. So a couple of numbers to keep an eye on there. If you're trading the Loonie in particular, watch out for those CPI numbers there. Bit of an influence on obviously the Bank of Canada and their potentially slowing down on rate hikes. If this comes in a big hefty print, that's going to put some pressure on those expectations, which could obviously influence the CAD. Right, just going back to some of the other headlines, back to Europe, and speaking of energy, and German Economic Minister Habeck says that energy crisis is not over yet. The aim is to declare it as being over in 2024. But if we manage to come out of the winter months with adequate gas storage levels, we won't experience last year's frenzy again. Never say never, mate. He says there is justified reason to hope that we will be able to fill gas storage facilities at adequate prices for 2023-2024 winter season. At the moment, a bit of a cold snap coming into particularly UK, a bit of Europe, but at the moment, nothing really significant that might put pressure on winter supplies for gas going in. So things are staying pretty steady there. ECB's to costs expect significant rate hikes to continue. ECB's Lane saying that the ECB must raise rates high enough to restrict growth. I still find it bonkers in this day and age that a central banker can get away with saying a line like that. We know what their mandates are, mainly inflation for the ECB, but to say you want to actually damage growth is still bonkers, if you ask me. BOJ's Bailey was waffling in front of the Treasury Committee yesterday on the emergency measures that they did last August, autumn, and said he's likely to see inflation fall in the year ahead as energy prices decline. Again, another no shit Sherlock. He also confirmed that the Bank of England made a profit of around 3.8 billion on those emergency bond purchases last year as well. Nice work if you can get it. Now, what happens at the beginning of the year is we often get a lot of forecasts from banks and the like institution telling us what they think is going to happen in 2023. It seems a lot of those late year forecasts are being torn up and thrown in the bin in the first 16 days of the new year. Morgan Stanley now sees the Dixie at 98 by the end of the year versus its prior forecast of 104. They also now see euro dollar at 115 by the end of 2023 versus 1.08 prior. And dollar one CNY, the onshore, at 6.65 at the end of 2023 versus 6.80 prior. They're not alone. ING, as they say, we are giving our euro dollar forecast a factory reset. They now see the end of year euro dollar at 112 versus 1.0 prior. Just a thing, my own personal view on bank forecasts is they're not worth shit. A lot of people make a lot of fuss when banks issue new forecasts. Oh, look, JP Morgan's got new forecasts out. And the fact that if you have to change your forecast after 3 months, it doesn't say a lot for your forecasting record in the prior 3 months. These guys are supposed to be the smart lot. If you can't make a forecast 12 months ahead and stick to it, then what's the point of making them at all? But such is life. It's good for clickbait, and the market gets stuck into it. What is the general trend from a lot of banks is that they're raising their forecast for euro dollar and overly moving to a more bearish stance on the dollar. So if you believe the that they are a indicator of opposition, then we're probably seeing going to find a bottom in the dollar soon, just as they all turn bearish, and we probably find a top in the euro dollar as well, just as they turn bullish. But anyway, you know where to get the best forecast, and that's right here at ForexAnalytix from all the team here. That's it for what I've got on the headline front for now. Kay, you got any bits and bobs you want to add in now?
No.
Nothing at all.
No, I think we covered everything that happened overnight anyway. No, I don't see anything else really. Just keeping an eye on the screens. Davos is on the way. Von der Leyen is bubbling, but nothing really coming out. OPEC says they want to stabilize prices. Read probably keep them high, but it had just a little effect on oil, not really much. No, moving on.
Yeah, I was going to take a quick look. I'm still long a little bit of this from last week. It is struggling into this 80 level. Got the trend line there. Got the 55 moving average there at 79.85, depending on where you're drawing your pencil. So just struggling at that level now after the bounce we've seen from those 72s. I think a bit of wait and see we're going to see here with this. I would have thought that it might have been a bit higher on the Chinese numbers, but it wasn't. So we've probably previously been pricing in the reopening saga, if you like to call it that, which obviously would be good for commodities. But the fact that things weren't as bad and we didn't see another pop in oil significantly suggests we might be at a bit of a balanced level for now. But that's the marker. I did miss a move up to 80 on Friday. I'm going to be looking for a little cut of my long if we do get a shift above 80. But otherwise, as I say, this is a bit of a struggle line at the moment. That 77.80, 78 level is, in my mind, a bit of a breaker for this phase and rally. So if we get back under there, we could see a bit more downside to come there. Just looking at it now, we're up above 80, so I might take a little bit of profit in a moment. Euro sterling, as Charlie mentioned, and you've got to realize with this pair, it is the definition of patience. Sometimes you can sit and watch this in a 20, 30, 40 pip range for days and days on end, and I think we're entering one of those periods at the moment. What it is doing is it's keeping more to a bullish side. We're not having another look down towards these sort of lows. We're staying fairly tight. I think it is going to be a bit of a case of watching the clock. If we can't get up here and break this 89 level, or even break the highs over sort of next few sessions, then maybe some of the short-term players will give up the ghost, chuck in the towel, and we may get a steeper pullback, maybe down to low 88s, even down to some of these lows here. That's what can tend to happen at times. The market just gives up weight, gives up holding a position, and gets out, takes some profit, and looks to go again. I'm still looking to, like Kay, I'm long still a bit. I'm looking for a break up. I'm interested in buying the pullbacks, but I won't be going heavy into them while we're just going sideways between this 87.70 and the high 88s for now. I still don't really see any catalyst that will kick this out of gear.
Tomorrow, maybe.
Sorry, mate?
Tomorrow, maybe. Tomorrow we get CPI and PPI out of the UK, right? So that should be a mover tomorrow.
Yeah, I think if we're talking the fundamentals, we know what the ECB are doing. We half know what the Bank of England are doing regarding rates. I still feel that the Bank of England are going to be pressured into hiking more than they expect, which will obviously potentially be a positive for the pound on the divergence trade. And in that scenario, I can see us pulling back. How far is going to be the question. I very much doubt, unless the bank indicate that they're going to have to take rates to 5% or higher. I very much doubt we'll get down to these 85s, but it could be a case that the Bank of England are forced to hike for maybe a bit longer as the ECB begin to slow, perhaps, maybe in the middle part of this year. And in that case, then the divergence may put a bit of more pressure on this pair, and we'll see it get down to those 85s. Sorry, Kay, was you chucking something in there?
No. Please go on. No, I said it's hard to see it back down in the 85s right now unless we are getting a bit more hawkish, Bank of England, and because so far they have been hiking, but the message has never been really hawkish, right? On perhaps on the yields, saying that they needed to hike more because of they were fighting inflation, but on all the rest, they've never been hawkish on the economy or it's all good and everything like the Fed could be was last year, right? So in that respect, and it's always difficult to sell a currency where the Bank of England, where the central bank is forced to hike more, but yields are not the whole story of a currency, right? Otherwise, we would never see stuff like MEX or Rand decline. It all depends. It all depends what the underlying economic situation is telling us.
Yeah, definitely. So I think, as Kay points out, we get the CPI numbers. If they are strong, that we should probably see a bit of a reaction in euro sterling, maybe a push down to the low 88s, maybe even down to that 87, 70s area. So keep an eye on that. Could be a potential place to add back into longs or pick up some if you haven't got any on board at all. Looking around some other pairs, a bit more treading water going on. Euro dollar in particular, still holding the 108 level, but messing around in this zone as well. Not really having a look back up the highs. Obviously, US holiday yesterday meant that it was pretty quiet trading, but nothing much on show this morning either. Dollar yen is continuing to look a bit bullish, at least in the short term intraday. It's keeping it up after we've had that bounce off the lows. This isn't really unexpected in my opinion. I expect to see plenty of action going on in the yen, maybe a bit of squaring off, position adjustment. Today's session could be quite important for this pair, the dollar in particular, as obviously the US come back from their holiday and trade all the news that's gone on the weekend and yesterday. So on that front, you want to be keeping an eye on yields at the moment. We've held pretty much this 3.4 area back into the 3.5s. Again, not looking an overly strong bounce, given how yields have moved of late anyway. Is this a dead cat or is this just a bit of a pullback? We don't know. I think, as I say, when the US comes in today, we'll see what they do. If yields tick up to 3.6, maybe we see dollar yen following as well. But how far that's going to get before it sticks into the Bank of Japan orbit, I don't know. So for the moment, trading dollar yen, I'm sitting on my hands, bar what I've got and managing already because we've got the big event coming up and everyone's waiting for that. And just to repeat, for me, it's a binary event. There's so many people with so many different expectations for this. We could see a big move, or likely to see a big move either way. We could be back at 131. We could be down at 125. Who knows? But just to reiterate that there is big binary risk volatility around this one. So do be careful if you're not trading it and looking to get something, or if you're in a trade, you want to maybe be a bit protective of what you got on. Kay, you got any thoughts on any pairs you want to discuss or have a look at?
I can have a look at a couple of things. Yeah, why not?
One of these waiting days, isn't it? Waiting periods,
Well,
we did last week for the CPI.
We call it a transition day, right?
Yeah.
Transition, but you know what? Even on transition days, we have seen decent moves in the past. Not necessarily in the majors like the euro dollar or cable or so, but if you look at stuff, for instance, I mean, Aussie, Kiwi, it's all like seems the market is still nervous enough or illiquid enough to make stuff move. So this is going to be decided by the BOJ tomorrow. There's a couple of things, and I'd like to talk about the BOJ because their decision will be made before our next flow show. This is where the highs were in back in 2015, and this is somewhere. Where is it? This is Davos. This is Mr. Kuroda announcing that in Davos that they were putting in place YCC and sending Japanese yields already a bit lower again. Tomorrow it's going to be the case of whether we are going to see the move to the other side. So the possibilities are, well, there's many possibilities really, but the main ones to look at is whether they announce the end of the negative interest rate policy. So they are now on the short end is now at minus 10 BPs. They could go to 0. Then the next one is to see whether they, and to what degree, widen the yield curve control. So we could, a few scenarios would be, so they could keep it still, in which case there's going to be a massive amount of pressure, and then they will have to announce unlimited JGB buying across the curve to stop the market from breaking them virtually. They could go up to 75. They could go just widen the band from plus minus 50 BPs to plus minus 75 BPs, which would take us back to this kind of level. And then they could go shift the band. For instance, they could go from minus 50 on the downside, which is a bit ridiculous right now, and then put it at 1% on the top side. If they would do so, whatever they do, when they move, if they keep YCC and they move the YCC band, I think the market will be strong enough and crazy enough to go and straight away test the top end of their new band to see their resolvence to test the Bank of Japan. The next thing they could do is to abandon YCC on the 10 years and putting the 5 years, the 5-year max. So that's another thing they could do. They could go, for instance, the 5 years should actually be rather trading around the 0.25%, but now it's the market is testing them. They could actually put YCC and a firm yield cap of the yield on the 5 years, whether it be a 0.25%, whether it be 0.5%, for instance. That's another thing they could do. In which case, the 10 years should fly a bit, but that may, in the end, be a move that could see the yen as a currency move the least. Yes, the 10-year is going to go higher, but then keeping the short end covered should dampen a little bit the effect on the yen. That's my personal view. And then the last crazy expectation, to me, is still not my base case. To me, the last crazy expectation is to abandon YCC once and for all, and that's going to be the I don't know what's going to happen. I mean, dollar yen could trade 125 off it, or 123, 120, whatever. We could see a 10% drop in dollar yen. It's possible, but I don't think it's not my base case for now, and I've been wrong in the past. But I do not think that the Bank of Japan is ready to abandon yield curve control in what or the other form. Because they would absolutely kill their government needs and needs to finance the stimulus packages, and it would create a mess in not only yen but in other markets as well. You would see massive swap moves in dollar versus yen, in euro versus yen, for instance. I mean, it's a scenario which you cannot rule anything out, but it's a scenario where if they just abandon YCC, I think I'm just going to close my screens and wait for the next day to see what the market is doing with everything, because it would really.
It's a hand grenade, isn't it?
Sorry?
It's a hand grenade.
It's crazy. It would be a crazy. I think we could see some really crazy moves if they abandon YCC once and for all. Okay, so for what the levels are concerned tomorrow, my base case is that the Bank of Japan is still going to move slower than other central banks. That being said, we know that other central banks are on the slowing side. So the effect may be a little bit, I say, subdued is not the right term, but temporary. If they do just very minor tweaks, because they will still be well below other central banks' interest rates, and if they, for instance, say like, okay, we widen a little bit, but then we go unlimited JGB buying at any rate where they put the YCC now, that's going to be perhaps a move that's putting dollar yen back higher. So we are looking at the weekly cloud here. The top of the cloud is just around 130. We have like 130 and a half here on the last leg higher, on this big leg higher. It's also the 130 and a half was also the springboard from where we went up to the 152. So that would be the first zone to watch, in my opinion. If you look at it, the 55 DMA comes in at 135, 131.34. So 131 and a half is for me the zone, and we can't put anything really more narrow to it in the immediate move after the Bank of Japan than that. So that's the first zone that I will be watching. If ever we start to move back above there, then we are going to have to watch again if dollar yen can reach that 134 and a half, which capped it last time. And I think that 134 and a half should be pretty key for the dollar yen. Call it 34 and a half, 35. That should be key if the dollar yen rallies again. And there's a lot of ifs. On the other side, we've got two very well-defined levels. It's the 50% of the 102 up to when we started the big rise in dollar yen from here. 50% is 127.35, and we have this big wedge, or how you call it, wedge, to reckon with the upper test line, if it's still valid after that many years, coming in right there as well. Then we have, if you take the whole pandemic low into account, we have the 126.60. So that's our next level to keep an eye on. And then the 61.8 here around 125 and a half. Those are three levels that I really would keep a close eye on and keep in mind, write them down and see what happens there. So low 127s, 126.60, 126 and a half, 125 and a half. If we start to break below those levels, then I don't see much to stop dollar yen from going back down to close to 120 probably. But before that, we need to know what the Bank of Japan is really going to do with it. And then, as Ryan already mentioned yesterday, we'll have to see what happens with the CPI come Friday, because Bank of Japan could be cautious. We could see this rally in the dollar yen on the back of a bit of a stalemate, perhaps. And then the CPI coming in again very hot, that would probably send the pair immediately back down, right? Because then the market is already going to focus on the next meeting, and then in between we will have possibly, even though Suzuki said they they may or may not announce it on the 10th of February, but we might already have news then about who may possibly succeed, follow up after Kuroda. Okay, that for what the Bank of Japan is concerned. The process, we could easily run through. It's going to be a pretty similar picture. But if you want to keep tabs on the euro yen, I think 139, that's too close. Keep an eye on this prior low here, 137.40s. It's also a prior low here. If it crashes through, we could be on our way, why not, to somewhere around 133, which is the August 2022 low before reassessing, depending on the Bank of Japan move. If we see a stalemate, I would not rule out that sooner or later we see a test of the upper side of the channel again. So it's just above 142 now. Call it 142, somewhere around there before we get there. This is the big level on the top side, and add to that high 142s where we saw here the double top of the last move. So these are the levels to watch on the top side. The rest of the currencies really, Aussie yen, we've seen this channel cap. So we are going to go into the Bank of Japan, watch 91.5, 91 and a quarter, 91 3/4. Those are the levels that you watch on the top side. Downside 88 and a quarter are the first levels to watch. If really something's happening from the Bank of Japan, those things could really move very, very fast. And why not have a look at the bottom side, which is around of the channel, which is around 85. And it's a similar thing for all the yen process, really. Look what dollar yen is doing, and then get your levels ready on the process and see where we end up. Also comparing to where the other dollar pairs are trading at the time. Yeah, Ryan already spoke about the euro sterling. The euro sterling, it's still the same level, right? This is the one where we have to break above to keep on going. Call it 89, 15, 20 euro sterling. Yes, the data came out a bit on the better side. Yes, euro sterling is coming a bit lower. Yeah, I'm actually flat right now. I don't really know what to do with it, and I'm going to see if we get another cap up towards 89, perhaps even try to counter trade it with a stopper reverse above, or wait to see if we can get back 88.40 and low 88s. The zone of no return to me still hasn't changed. 86 3/4, 87. That's going to be the big one. If we get moves below 88, then I'm probably really starting to rebuild this one. And on the rest, euro dollar can't go anywhere. We'll see what that does when the US comes back in. Cable is still ping pong around 122, 121 3/4, 121.85. First bit of support, those prior bottoms here, and then 122.40 again after the jump above and the failure. That's it on that pair right now. Aussie Kiwi did not hold the 108.80, so we saw a bit of a, I think it's a bit of a stop run or failure run that we saw down to 108.50s, where there's a bit of support. I think the bigger support should come in around 108 and a quarter. In the meantime, yeah, we're just turning around. I think it's more to do with China than really the Aussie and the Kiwi numbers, which were a bit divergent, actually pro Aussie, but it didn't help the Aussie Kiwi a lot overnight. So for the time being, I'm just watching this and waiting where we close the day, really. If it gets back down, I think I may start to get interested again. And that is really it for me, Mr. Ryan.
Thank you very much, mate. Good stuff as always. Now, again, I can't help but reiterate that if you're not trading yen pairs, you can't ignore what's going on, because what happens here in yen pairs is going to be a very, very big influence on the majors. So if you're trading cable, you're trading euro dollar, you're trading the loonie, anything else, even some of the other crosses and currencies, there's going to be if there's big moves, it's going to drag on the majors. So for example, let me share my screen. So for example, if we get a big move south in something like euro yen, it's going to drag down euro dollar. Now what you want to do, if you don't trade the yen, you trade the majors, what you want to do is take a snapshot of what is happening in the other pairs, and then what you look for is, does the cross euro yen kick euro dollar out of kilter with what the trend is? We know what the trend is. The trend has been going higher for a while now. So if we get a huge move in euro yen and we see euro dollar reacting, and maybe it comes down to 106 or 105, something like that, that's when you need to have a look at it and think, well, okay, I understand why the yen's moving, but has this now kicked euro dollar out of sync with what its trend is? And that's the sort of opportunities you've got to look at and make those decisions then, because that's what I'll be looking at. If we're down here 105s and it's all down to the euro yen, I'm going to be thinking, right, well, I'm thinking about fading that because it's pushing the price of another pair out of sync with its fundamentals. So you can't ignore, if you're not trading yen, you can't ignore what this is going to do for other pairs. That's the most important thing, because it is such a big risk event tonight. It's probably bigger than the FOMC, most definitely, even if they do nothing. So yeah, that's all to come. It's all going to be a lot of fun. Dollar CAD, just look at that quickly. As we got the data coming up, as we saw on the CPI, expected inflation on year expected just to pull back a bit to 6.4% from 6.8 expected. On one of the main core numbers, expected to dip to 6.6 from 6.7. So we are seeing oil bullish, but as you can see, we're not seeing CAD strengthen while oil is rising, and oil's up now trading at 80.25 on the WTI, and we're not seeing CAD strength on the back of that. So we're not really on the oil bus here at the moment. So again, if we get some strong CPI numbers and that sends dollar CAD lower because of expectations for the Bank of Canada, again, that may be something you may want to counter if the trend of the day is still dollar strength and we see an oil rising and not playing ball there. So look for these little effects that kick a price out of sync, and that's what I like to trade quite often there. I don't have much else to add, but do keep an eye on that data and keep an eye on that New York Fed manufacturing, because it is going to be a bit of a bellwether for the start of the year. Manufacturing in the US, the first number. We know the PMIs, the ISMs been looking very poor of late. So are we going to see a bit of a rally on the data first month of the year, or is it all going to be bad news again and the dollar suffer and yield suffer from that? Very good luck for you today, guys and girls. Please stay safe with your trading, and we shall be back tomorrow morning. And thank you very much, Kay, as always.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.